Welcome to Key Points for August. Now this month we take a look at the continuing economic slowdown, what this means for central bank policy, and as a result of that, what the prospects are for financial markets. Now turning to our first point, global growth continues to slow down pretty much as we had anticipated, but it is continuing to broaden out. The United States is in fairly decent health, the jobs market is strong, but even here we're seeing signs of weakness coming through. But it really is in the Eurozone and elsewhere that we see a more pronounced slowdown. The business survey data in France and Germany are frankly horrible. It implies that the industrial part of these economies are in contraction. And when we look at the latest trade data coming out of Asia, there's really no sign yet of any stabilization. Indeed, trade conditions appear to be deteriorating even further. Also, from an inflation perspective, we're seeing that this slower growth has meant that inflation remains weak. And indeed, we've seen inflation expectations, the market implied expectations, fall fairly pronouncedly in both the US and in Europe. And that's a real concern for the policymakers. Now this takes us to our second point. This benign inflation environment and weakening growth has led to an increasing number of central banks cutting interest rates. We've now seen Indonesia and South Korea add to that list, and we've just had the ECB really tee up an interest rate cut for, we think, in September time. And as this video goes out, we're likely to have seen a cut by the Federal Reserve in the United States, the first time following 9 interest rate hikes. So the central banks are in easing mode, trying to bolster these economic conditions. But unfortunately, while we applaud that, we think that it's likely to be a little bit too little and a little bit too late. We need fiscal measures to come through as well. And consequently, we still imagine that growth will be slowing over the remainder of this year and into next. Now, from a financial market perspective, investors have certainly been cheered by this liquidity provisioning. We've seen equity markets, credit markets do well, and we've seen bond yields come down even lower. In the case of Germany now, record low bond yields. And indeed, in the credit markets, even high yield, believe it or not, we're seeing some high yield issues trading with negative yields. So investors are clearly looking at the liquidity that's being provided to lift all boats and are extrapolating that. Indeed, we're seeing the equity markets move up further and further. Now, while we think this can last for a little bit longer, ultimately investors must ask, why is it that rates are being cut? And of course, they're being cut because economic conditions are challenged. And indeed, we've just started the earnings season. We're likely to see, again, very anemic earnings growth, if any growth at all, coming through in some of the major economies. So while there's maybe a little bit further upside for equities and credits in the very short term, ultimately we think that the risks are increasingly to the downside as the fundamentals continue to deteriorate. And investors should realize that liquidity provisioning is not a cure for all things, ultimately leading to potential downside risks as we get into the autumn. Now please remember you can read all the details in our full report available on zurich.com/MSME.